Okay, so now let's try to understand these permanent differences and their cases which may fall under CPA examination, and let's go through them. So first example is the tax exempt interest, which is for the municipal or state bonds. So in US, when you earned interest on municipal bonds or state bonds, then that interest will always be shown into your books as per the gap. But as per the IRS or tax rules, there will be zero tax on those because these are tax exempt. So what is the impact? It will be having a permanent result that your book income will only be shown and your income tax as per IRS will be zero. The second example is the life insurance proceeds on officer's key person policy. So basically in every big company there is a policy known as key man's policy or key person's policy. When the key man or key person of any company, who is the most important person like founder, CEO, or the MD, who is the key person for that company, he dies, then the benefit is received like the insurance policy's benefit. Then that policy, if let's suppose received $500,000, then that will show as a book gain as per the gap. But as per IRS, there won't be any tax. Zero amount is taxable when this key man's policy proceeds from life insurance is received. So this is also a permanent difference. If we go to third situation wherein the life insurance premium when corporation is beneficiary. So basically this is the premium outflow, the money is going out. In above example, this was life insurance proceeds where we are receiving the money. So here there is an outflow of premium and the premium is paid on the key person's policy. So when the premium is paid, then there will be some expenses. This is not about income, this is about expenses. So gap books will show that this is an expense. But will IRS or tax authorities allow this? You will say no, they won't allow this deduction. Why? Because when on the death of the insured person money was received, this was not taxable. Then when the premium is paid, IRS will say we will also not allow this expense to go into PNL. Why? Because if this expense will go into PNL, this will reduce the income, and if this will reduce the income, this will reduce taxes as well. So IRS don't allow any expenses to go into the PNL, and this is also a permanent difference. The fourth situation is like certain kind of penalties, fines, bribes, and kickbacks, etc. So there may be a situation like on company they have done certain fraud or any other problem due to which there is a regulatory fine imposed on them. Now based on that, in their books of accounts as per gap, they will show the expenses of $20,000. But will income tax allow this? They will always say that IRS won't allow this expense. Why? Because these are penalties and fines and bribes based upon companies problem, companies have occurred them, these are not lawful. So IRS will say you can't deduct these expenses from your income, because if you deduct these expenses from your income, then your income will get reduced, and if income gets reduced, your taxes will get reduced. So this also creates a permanent difference. The fifth item is non-deductible portion of meal and entertainment expenses. So there may be a situation like a company gives the client, or there are certain meal expenses for the company. Now there are a lot of people who are eating within the company, and as per gap these expenses are shown within the books. But IRS allows around 50%, or this may change based upon the IRS laws which are introduced and updated yearly. So this is like 50% of whatever meal is there is allowed as an expense. So although you have done a meal expense of $10,000 as per the gap books, But in the IRS file, you can only allow a deduction of $5,000. Why? Because only 50% expense can be shown against what actual you have done. So this will also create a permanent difference. The next impact is the dividends which are received deduction for corporation. Now these dividend when received will have, let's suppose the example of 50% deduction is allowed, and this 50% will have different, or it may change, but in your examination it will return that what is allowed as per DRD. So you can say that dividends received from another corporation. Now your company has received dividend of $100,000 from other company. Now that dividend is taxable only up to what? You can say 50,000. Why? Because there is a dividend received deduction of 50%. So 50,000 won't be taxable and 50,000 will be taxable. This difference of 50,000 will, I can say, is a permanent difference. And the seventh impact is excess percentage depletion over cost depletion. Now this is about the depletion method, which we will be covering at a later stage, but this is simply says like in your books the depletion allowed is 60,000, but as per IRS the depletion is $90,000. Then what will happen? Only extra 30,000 tax only deduction. Then the differential extra 30,000 will be allowed for deduction. Now we will be covering this later on, but this is about excess percentage depletion over cost depletion. Now let's see whatever we have seen through a textbook example. So the textbook simply says that permanent differences are the items that affect book income but not taxable income, or taxable income but not book income, as we have seen that here it was impacting in the case of life insurance it was impacting the book income but not taxable income. Here this was impacting uh, book income and tax income, but the differential impact of 5,000 will never get reversed, so that was a permanent difference. So within that there are three categories basically, we can say. One is non-taxable item, next is non-deductible items, and third one is special tax allowances. We have seen all of them above. Let's see what are these. So the non-taxable items are like the tax exempt interest, like on the municipal or state corporate bonds or bonds, basically there is no tax on their interest. Similarly, if you receive life insurance proceeds on officer scheme and policy, if that person dies, then that insurance proceeds is not taxable. The next category is non-deductible, which is like life insurance premium you are paying. This is an expense. These above were incomes. So life insurance premium when the corporation is paying, this is not deductible. There are penalties, fines, bribes which the company pays to any other person or corporation. Those are also not deductible. When I say deductible, that expense will not go into P&L, and if that expense don't go into P&L, it won't reduce the tax, right? And next is non-deductible portion of meal and entertainment expenses, as we seen above. And lastly, there is a special tax allowance category as well, wherein we can simply say dividend received deductions for corporations. We have received certain dividend, but that entire dividend is not taxable. Some portion of that dividend is taxable only. And then excess percentage depletion over cost depletion, which we have seen. So this were some of the example, and it is expected that your examination will cover these many examples only. So you need to understand them in a precise way.